Hello, everybody. Oh, I just lost everyone's view. Okay, thank you. Awesome. Hi, hello and welcome. If everyone can see us and hear us, give us a high five. I see Tali. Hi, Tali. Love seeing people we know. Hi, Brooke. Okay. Hello and welcome, everybody. I'm Divya Kakkad. I'm the head of platform at Graham & Walker. Where are folks starting in from? Use the chat and tell us where you are right now, how hot it is. I'm in Seattle. I am dying. It is like a 90+ day. This whole week is a 95-degree week, which is not usually Seattle, but you know, I'm gonna remember this for the rest of the year. Awesome. I see people from Houston, super hot, yes, Miami. Hello, hello. Thank you so much for joining us today. For those of you joining us for the first time, Graham & Walker is a venture firm on a mission to reshape the NASDAQ by supporting and investing in tomorrow's most powerful companies. Hopefully you are all part of our community and get our newsletter. If not, by signing up for this session, you will be on the list. Today, we are joined by our very own Leslie Feinzaig. Leslie is an operator turned founder turned VC. In 5 years, she turned a 25-person Facebook group into what is today a 50,000 strong community for women-founded startups and aligned investors, and raised a VC fund to invest in and with the best of them. She is the founder and managing director of Graham & Walker, an early-stage venture capital fund. As you registered for today's forum, you submitted questions for Leslie, which informed and prepared today's discussion. And I will, for the next 30 minutes or so, ask her some of those questions. And then after that, we will open it up for live Q&A from the audience. We will be recording this conversation for our website, but if you want to ask a question and you do not want it attributed to you, please feel free to DM me directly and I can ask them for you. And yeah, we want this to be a interactive conversation as much as possible. So feel free to raise your hand, put in a question in the chat, and we'll try and weave it in or call you up as we go through this conversation. Everyone ready? Awesome. Let's do this.
Yeah.
All right, Leslie, let's get straight to it. We know that this, the public markets have been down and the economy has been slowing. How is this affecting early stage venture capital, and why should pre-seed and seed stage founders care?
Yeah, I mean, I think that if you are here, then you are probably feeling it, or you're hearing a lot about it and wondering, so what? Like, how does this affect me? What do I do? And that's what we wanted to do today, was just kind of create a space where we can ask the hard questions, and you may not get the answers you want to hear. I'm going to say that right now. That's happening a lot these days. But you will get honest, non-judgmental answers. And so we're going to talk about all the things that can result in bad outcomes, right? Like layoffs or having to shut down your company. Like, all of these are conversations that people are scared to have these days. And we just wanted to create a space for you to have them. And with that said, it's not all doom and gloom. There's actually a ton of opportunity happening. So with that, let me answer your direct questions. Is like, what is going on, right? So listen, the past 2-3 years have been wonky in all kinds of ways. And yes, even though I am actually a trained economist, I'm not going to pretend to break it all down for you because I haven't practiced in a long time. But you've been reading the news and you know that we have been living in extended boom times for a really long time. Since the recovery from the 2008 recession, We've been living in essentially boom times all across the economy. This is fueled by low interest rates, like really free money. The markets were growing a ton. And there was all this extra cash out there, right? Like if the stock market is growing a ton, then all these institutional investors are looking for different places to find more growth and where to put their cash. And a lot of cash ended up being put into the world of venture capital. Cash that would not normally have been deployed there, right? Like over the past few years, we have seen what we call crossover investors dip their toes initially, and then dive right in to venture capital. These are folks like SoftBank, right? They were not originally a venture capital investor. Folks like Tiger Global. And a whole many more whose names you've never heard of because they're not quite so public. They're hedge funds, they are institutions, they normally stay in the world of private equity, they normally stay in the world of publicly listed asset classes, but they've been chasing growth for the past few years. And with all of that extra money in venture capital, the sector got really, really hot. And the rounds got really, really big. The valuations got really, really big. And that's kind of shaped the mentality of Silicon Valley for the past 5 years. Silicon Valley kind of broadly, right? Like American Silicon Valley. The thing that happened this year was that through a confluence of factors early kind of in Q1, the expectation was set that all of this free money, all of this cheap money was going to go away. And over the past 3 months, essentially what's happened is that it is going away. First, because when the stock market goes down, all of a sudden, a lot of those much safer investments look pretty cheap when compared to these really risky venture capital companies. Right? If you're publicly listed, that means that all investors can look through your accounting and can actually do full diligence on how you're doing. It means that you have revenue, you have a multiple, like you're a very discoverable business. It's a lot less risky than venture capital. And so if there's kind of cheaper tech stocks that have way more revenue, so a lot of that crossover money was expected to go back into the tech stock world. The second thing is, with the stock market going down, all of a sudden it makes the exit opportunities for the late stage companies look pretty bad, right? So like late stage venture capital companies at some point have to return capital to investors, and they do that either by getting acquired or by going public. Those are kind of the two big options at the late stage. But, the stock market is down, and all of a sudden it doesn't look quite so attractive to go public because you're not going to get a higher valuation out in the public market than you would in the private market. I hope I'm not losing you guys. I can't see your faces. Are y'all sleeping on me? Okay, hold on. I'm just gonna like sleuth you. Let me see. Shiny, bright faces. You're so excited. This is like the most interesting thing ever, right? Yeah. Okay, totally. Great. You're still with me. If I get too boring, like somebody like virtual slap me on the comments, all right? Okay, so basically late stage markets shut down. And all of a sudden, all of these late stage companies are scared that they are running really, really expensive operations. They don't have all that much capital in the bank, depending on where they're at. Oh, thank you, Katie. That's such a nice comment. Who's Katie? Wherever you are, thank you.
I am Katie.
Oh, that's lovely. So all of those late stage companies are running out of money, and all of a sudden it's sort of like that game of musical chairs. Like they're looking for another investor to like give them more money at a higher valuation, and there's kind of no one there. All of that trickles down all the way down to the earliest stages. So if there's no appetite for late stage venture capital investments, that means that at every prior stage, the investors are going to say, okay, well, deals have to get cheaper because there's not as much upside in those deals as there was a year ago. So that's basically what's going on is this all of a sudden, Q1, I mean, it's hard to convey if you haven't been looking at the numbers, just how bonkers the venture capital world has been for the past 2-3 years. Valuations through the roof. The deals were like, and we'll talk about underrepresented and women and all of that stuff. Like, we will get there, but by and large, like the mainstream market was just bonkers. It was just nutty. You had days to, they were like competing for space in these hot rounds. And so they were like overpaying dramatically for these companies. You had to make up your mind essentially without doing any diligence. You had to like invest almost blindly if you wanted to participate at all. And all of that died down basically overnight in mid-May. Like it really, truly like whiplash overnight. Over the past, let's say 3 months, May, June, July, what we've seen is that essentially at every stage of venture capital, deals are way slower, so they don't go as fast as they used to. They are cheaper, so the valuations are not as high as they used to be, and that's the case again in every stage. Investors are taking their time and going back to doing diligence on companies, trying to get to know the founders. They're much shyer to make a commitment. And, in the past month, this also coincides with summer, which has traditionally been a pretty slow time to raise venture capital at the earliest stages. All of that combined means that if you have been out raising capital in the last 6 months, you may have noticed a dramatic slowdown in the responses that you're getting, and just like a really difficult, way more difficult than before, a difficult time kind of getting that snowball effect of people getting excited about your round and getting closer to the ability to close. So that's basically what's happened.
That's super.
I can keep going.
No. I think that, it's really helpful because you're sort of putting context in, because while you say that, funds that have, raised capital and actually have the dollars to spend, that still exists, right?
Yeah.
So actually, this is a great time to talk about dry powder. So when VCs tell us, no, we are still investing, there's plenty of dry powder, what does that mean? And how are early stage VCs now thinking about their capital deployment strategy in this environment?
That's a great question. So dry powder is what we call the money left in a fund to deploy. So when I raise a fund and I close it, it is 100% dry powder, right? Like I have X number of years based on my contract with my own investors to deploy that capital, or in other words, invest it in companies like yours. So with our fund, for example, we are 50% deployed, and so we have 50% dry powder. And if you go out and kind of look at news on like when did people close their latest funds, you have a sense of how much dry powder, how much additional cash they have in front of them. And by and large, there's a ton of dry powder out in the industry right now. Like a lot of VCs close. So the expectation is 100% that investments are being made, and they will continue to be made, and there will be opportunities for great companies. The thing that fell off was the fluff.
Yeah.
Right. Like the sort of the investing blindly without being able to do diligence, the having to make up your mind overnight, the investing earlier and earlier at idea stage because there was so much demand. It's sort of like every investor is taking their time with deals, and so they're just kind of less competitive. So that is the thing that fell off essentially. And the other part is the valuations, right? So like founders are kind of coming in with an expectation of valuation that was shaped by a really frothy market, right? Like top of the market behavior. And now we are kind of in more of what should actually happen. Like this is a healthier valuation market, but to the founder, it just sort of feels like, how did I lose value overnight? Like I didn't do anything, right? And it's not you. It's sort of like a demand and supply side of the industry.
And to a large extent, it is a correction, because we did agree, at least on the investor side, I know that we've talked about this a lot, that it was ridiculously frothy. And we knew that it wasn't sustainable. And it's sort of that correction now seems like as if it's, I mean, really harsh on the founder side, but in a way, the due diligence, I bet a lot of funds will say that they were still doing it, but I think that was required, right? Yeah, we know.
Yeah.
Yeah,
that's 100% true. Like, it is, and I want to remind you, like, I've been on your side of things, right? Like, I've literally sat in your shoes. And I'm not a natural VC. Like, I'm not a natural deal maker. I don't like being on opposite side of the table from the founder. And luckily, you're only on opposite sides of the table or you're negotiating the terms, and then afterwards you kind of get back on the same side. So, I'll be okay. But I know that it feels rough to the founders, but what I can tell you is kind of having this bird's eye view of what's happening in the industry. Like, I think that this is the best thing to happen to venture capital, like, truly, because when we do diligence on things, we invest in ideas that are a little bit more further along, and the companies have a lot more discipline. And again, right now I'm talking in generalities. I think we will focus on kind of the underrepresented founder, the women and non-binary founder world shortly. But this is kind of industry-wide, and it's trickling down to everyone, basically.
There's a great question in the chat by Katie that says, if you have reason to believe that the recession, if anything, would drive your valuation up, how do you suggest having that conversation?
I mean, it would be, there are industries that are recession-proof, but it is really hard to claim that the recession itself would drive up the valuation of a very early stage company. So unless you're on the later stages where you're getting closer to being valued on a multiple of your revenue, then it's unlikely that it's going to touch. Early stage valuations are by and large fairly standard. And they're not pegged to the immediate economic environment. They're pegged to the expectation of outcome 10 years down the line. And for God's sakes, let's hope that 10 years down the line, we are out of the recession. So that's why, it kind of doesn't matter. So I would say it should not really drive up your valuation unless you are pretty late stage.
So for super early stage, seed stage companies, can you talk a little bit about what impacts valuation, or how they should be thinking about this? I have a question that was DM'd to me about how does this impact early stage and angel investors for those who are raising pre-seed and angel rounds? I just want to make sure I paraphrased it correctly.
So I think I want to hear that question again. But there's two parts to what you just said. One is the valuations, and the other is angel investors. And I think that those are two different topics.
Okay, let's talk about valuations first. Like, how do you determine valuation at such an early stage, and then talk about when you're trying to raise like super early in this, does this market impact that?
Yeah, yes, it does. It very much does. Okay, so the first thing I will say is, do not determine your valuation but by what your buddy said you should, or by what you saw somebody get. That is the truest way to fail. Meet with investors that you know and trust, and syndicate it, and just see what the market will bear. And I would say now is a really important time to be humble about that early valuation. I will tell you that for the past 2 years, I have been having the conversation with founders, trying to either talk them down from a too high early stage valuation, or at least sort of explaining what might happen if they raise at too high a valuation too soon. And I realize that this is as a founder, it sort of feels like, well, you think that I'm worth less. It's not that at all. It's really important to think of your valuation not just as what it is in that moment in time, because it is absolute, it's fake money, right? You don't have revenue. You're not actually worth a multiple of something real. You're an idea and some execution. So the valuation, what it really is a expectation of what your next stage of growth is going to be, and what the expectation of what your next round is going to be. So when you raise at a reasonable pre-seed valuation, the next time that you go out and raise, you're going to have an easier time getting a step up from that, right? So like if you raise at a 5 million post, I'm just making round numbers. The next time you go out, try to fundraise, you want to raise at a 10 to 15 million post. The metrics that you need to show to achieve that are much more reasonable than if you try to go out and raise at a 50 million post. Does that make sense? Can you guys give me some like nods if this makes sense? And if not, tell me in the chat. It's sort of like saying, imagine that you are graduating from college and you try to go to your first job and you are optimizing for your title. And in your first job, you negotiate that you want the title vice president. Chances are in your next job, you're going to get a demotion, right? That's basically what we're seeing here is like, you need to be able to raise at the next valuation in each additional round. What happens when you raise too high too early? It's just much harder to raise the next one. And so you're dead, right? Like 100% of zero is zero. So that is the thing. And you know, if you are optimizing, if you're like greedy too soon, we are concerned that you're not going to have enough traction to raise the next round, and therefore you're going to be dead in the water. And this is another thing that we tell founders all the time. I think that there's a couple of people who were in our catalyst here before. So you've heard me say this before. Success is not this round. Actually, success is not even this startup. Success is not wasting time. That's what success means. It means working on the right things at the right time so that you earn the right to keep working on it until you have the outcome that you want. So the first thing is like, stop optimizing for this round. That like spiel that I just gave you about, hey, if you raise a too high valuation, you're going to have a really hard time raising the next round, and therefore you're not going to get anywhere. That is essentially bearing out for a whole bunch of startups that raised in the past 2 years. They raised too high and now nobody wants to pay that. And a lot of them are raising extensions, cutting their valuations, trying to borrow money. Like they're basically dead. Like a lot of them are dead in the water. It's extremely hard. I apologize if I'm being too glib about it. And if you are in those shoes right now, if anybody here is in those shoes, I apologize. If it sounds like I don't care, like I realize that this is extremely rough, but this is essentially what is happening. I think that reality of like, you raise too high, you're not going to raise again, is coming to fruition now, but investors are not pushing those valuations high to begin with as much as they were before. Like a lot of the responsibility in those early rounds is that like investors were pushing them. Like if investors are willing to pay them, then like you'd be stupid to say no, right? Like it's really hard to say no. Although a lot of founders do. And so now that's not happening. And so your early valuations are going to be much more realistic. I think, you know, we're seeing anything from 4 million posts, 5 million posts to maybe 10 at the very, very high end of those early stage companies. There's always exceptions to that, but generally not when they're idea stage companies or like very, very early companies with like first or second time founders. Like the exceptions tend to be, you know, truly proprietary R&D or like founders who have had massive outcomes in the past. Those are the exceptions these days, or just people who are like super well connected and, you know, annoy the heck out of you, but there's nothing I can do about those.
I want to answer another question that Sana asked about dry powder. You mentioned that the best way to estimate how much dry powder is left is usually based on when the fund is announced. But is this publicly available information on ongoing basis?
Like a lot of funds announce what, not on a quarterly basis, but like you can look for announcements, look for their blogs. A lot of funds
when the fund is
the size of the fund. And then like assume that it's going to be deployed between, I don't know, 2 to 5 years. So you can make some assumptions about like, hey, if the last announcement was 4 years ago, they have no dry powder. or they're working on a new fund or something like that. And then the second thing is like, you need to ask, like meet with that investor and ask, like, are you still deploying?
Yeah.
Don't be
I think something that you mentioned earlier really struck a chord. This is the time to sort of like build those relationships, right? Like, and go to investors that you've been talking to for a while and ask them, like to help you sort of navigate these conversations. So while tough, times are tough right now, can you tell us what you think founders can be optimistic about?
I mean, so first of all, if you're here, let me look at your faces. Like, all of that data that we've said over the past few years that we've been like spewing about, women founded companies generate twice as much revenue for every dollar you invest in them. I mean, by and large, if you are not in the mainstream of Silicon Valley, you're probably not, you never had this problem, right? Maybe a little bit, but not a ton. And so the first thing that I would say is like, most of you were built for this. Like, you're actually very like I am really excited about my portfolio because I feel like you're so much grittier. Nobody ever handed you anything, right? And I know I can't generalize. I don't know all of you, but that chances are things were never super easy for you to begin with. And so I feel like you have more grit in you than the average entrepreneur. So I think that is a massive upside. Like, you actually have a leg up. And like a lot of the froth is just going to fall off. A lot of those ideas that you're like, really, the world needs that? Like, that's just kind of going to fall off. And investors are going to be looking for real substantive opportunities, like true substantive opportunities, and you can shine there. I think that is the one thing. And then the other thing is just in general, I mean, not for nothing, but like, I do think that the best, like, I think that the next set of world-changing companies are being born right now. I really do. Because you have this need to solve real problems, because like sort of industry-wide, hopefully there's going to be less sort of money thrown at not real problems. And so I think we're about to see a ton of innovation. I think that's really, really, really good. Entering a recession, I think, is harder for everyone. The other part that is a lot easier, demonstrably easier, is hiring. That gives you a huge leg up. If you can raise capital, hiring great technical talent is going to be way easier than it's been in the past couple of years. And so that is another like major upside of going through this. And the final thing I will say is like, this isn't forever. This truly isn't forever. This is going to last a few months, maybe in the sort of double-digit months. I haven't practiced economics in years, so like, don't make this a prediction. But what I can tell you is it will end, and like everything that falls goes back up, and you have an opportunity to catch that next wave of opportunity. And it's going to feel amazing. It's going to be a ton of opportunities to like rise and do amazing things.
So on that note, to be able to ride this, this tough out, let's talk about being capital efficient. We know that women founders are intrinsically just extremely capital efficient out of necessity. Can you tell us maybe if there's a framework that you would recommend that founders use as they think about how and why to spend hard-earned dollars in this environment?
I don't have a perfect framework for you, but what I will say, because this is really, really, really dependent on what your startup does. What I will say is that times like this are forcing functions to think really hard about what matters to your startup. And at the very earliest stages, that is the thing that you need to do if you haven't yet. Remove all ego from that question. Truly remove all ego, all pride in authorship, all pride in idea making. Try to take a really stark look at your company and ask yourself, what are the things that are going to move the needle for this company, and invest in those, and everything else can fall off. So this is the time, if you haven't done that before, this is the time to do that. And what are the things that are going to move the needle for your company? I mean, it really depends what kind of company it is. It also depends on, do you intend to bootstrap for a while, or do you intend to raise more capital? If you intend to bootstrap, then, the right things for your company are how are you going to make revenue, right? So that you can keep going. If you're going to raise capital, then the right things to do for that company is to go talk to investors in that space and ask, what are the KPIs that you want to see for my next round? And that is what matters. And that's it, nothing else. Very, very few things matter. So we're kind of in start prioritization mode for a little while. And it can be painful, but it is so healthy, you guys. It is so healthy. It is a really, really good thing to do for your company. When you really discover hey, I've been doing all these newsletters, and actually they take a ton of time and they don't matter. Let's just stop doing it, right? Or I'm investing all this in developing more features for my product, and actually that actually doesn't matter right now because it's not going to move the needle really dramatically in either direction. So that's what I would do right now is focus on the things that will get you to a point of sustainability and growth, depending on what path you choose to take. Now, with that being said, sometimes being capital efficient doesn't get you anywhere, right? There is such a thing as if you are going down the venture path and you are staring at an empty bank account and you don't have enough time to do anything, then the decision has to be a little bit different. And that's where those are really hard decisions to have, conversations to have, decisions to make. But if you do have a little bit of runway, then, know what matters and focus on it obsessively.
I think that sort of answers the question that Rosalinda just put in. What do you focus on? Do you focus on growth versus cost efficiency? So it really just depends on your startup, what you are going through. Do you have runway? Where are you in that journey?
It really does. It really depends on your startup, and it depends on what your goals are. I do think that if the goal is to get to self-sustainability, as in to be able to operate your company off revenue alone, then you might do things a little bit differently than if the goal is to raise venture capital or to raise private capital of some kind. So yeah, it really, really depends on the type of business and what you want to do with it.
Okay, let's move on. I have a question from Celeste over here. I want to take it really quick. My company is 1.5 months from first revenue. I'm getting 2 sets of advice. 1, bridge round, and then Series A next year, or 2, seed round now. Bridge sends out a bad signal, does it? Can you help me sort out this advice? What would you do? Or what is your...
The first thing I will say is a truism, don't shoot me, but when you are getting opposing advice, that means that there's no right answer. So I hate to tell you this, but there's no right answer to your question. There's only what you decide to do. And that also means that there's no wrong answer. And so you can look at it that way and glass half full. I would say, so a bridge round versus a seed round. I would say the first thing I would say is throw out the nomenclature. Is that how you say that word? Just throw out the name. Throw it out.
Yeah.
And the comments are so good. Oh my gosh. I really wish we could just turn everybody's mics on and have a chat. Maybe we'll do it at the end. So throw out the name of the round and figure out how much you need to raise to get to the next round of financing. And if the next round is okay, so the next stage is $1 million ARR so that you can raise a Series A, then kind of work backwards from that on how much do you need to get there. And I think that if the amount that you need to get to that next stage feels like that is too much of a lift to raise right now, if you need $3 million and okay, the market is not going to bear $3 million, maybe you can do a smaller amount now and get to an interim milestone to raise the next one. So don't worry as much about the names, worry a lot more about like, what is the milestone that you need to hit? How close are you to that milestone? And does the market bear that full amount? And I think that will kind of clarify. I think it's more important to ask, how much do you need and for what, than what round to raise right now. It'll kind of help investors understand what they're buying into a bit more. Yeah, ignore the names of rounds. I've been doing it for years. Seriously, just ignore it.
There's also like just like pre and pre. We can edit anything out that you would like later, but let's yeah.
That's all my is that.
Hey, sometimes you just got to do it. It's what it is. Okay. This is a hard one. Sometimes extending runway means just taking some really hard decisions. It may mean letting go of team members, and in a small team, this can be much more hard, like much harder. What tips do you have to give founders to identify if that is what needs to be done, and then B, how do you do it in a humane way where you minimize damage to your relationships and to team morale?
I want to say, I mean, realistically, there's no way to do layoffs that where someone won't get hurt. I wish it were different, but that's just the reality of it. One of my mentors told me that there's a difference between being liked and respected. And I think that when you have to make and communicate really, really hard decisions, I think it's important to just let go of the idea that you're going to be liked, because you're not. And it just kind of is what it is. Hey, by the way, if what you need is to be liked, you're probably in the wrong job. So seriously, I certainly, and it's super hard. Like, I want you guys to like me. That's why I'm so funny. Just kidding. Like, it's really hard to let go of the idea, like, people are going to hate me, but this is a really hard job and it comes with decisions like that. So that's the first thing I would say, is like, just let go of the idea that people need to like you, and embrace the idea that you want to do things in such a way that they can respect it. And try to kind of put yourself in the position of like, what would it feel like for me to respect the person that fired me? And kind of think about that and do it that way. So I would say things like transparency. I would say things like doing it quickly. Like, don't sit on the right decision for a long time. I would say try to do what you can to help the people land somewhere if you're able to. I would say think about all of the stakeholders in your business. I had a conversation with a founder, I don't think they're here, but she was at the point where she had to let go of some people, and I don't think that she realized it. And I was like, hey, you are there, like now, right now. And they said, what do you mean? Like, you need me to be like, I'm supposed to just call them and like tell them that they're done and like not give them like advance notice? I'm like, you don't have money for advance notice. This is, if you don't own your fate, like if you're not operating off of revenue, if you don't have a bunch of money in the bank, you can either make the hard decision right now and give your company a fighting chance, and hey, maybe one day hire those people back. That happens when they respect you. Or you can drain your startup of the little money that it has left and basically kill the thing for everyone, including yourself and your investors. So, it's hard to talk about. It's extremely hard to do, but that's part of what you got when you go down this path. It just is not easy. It's not for the faint of heart, and this is kind of how it goes. The other thing that I would say is, if you are not there right now, that's great. I want you to a few things. One is stop referring to your team as a family. I absolutely adore my team. I have to say that, like, they're here, but we never call ourselves a family. We call ourselves the dream team. And that's because we're here to work together, and we play too, right? Like, we have a lot of fun, but we're building a business together. And so first thing that you need to do is stop referring to your team as your family and start acting as though you're an athletics team or a business, because that's what you are. You have to like set the expectation that together you're trying to steer this ship in a direction that's going to be a great outcome for everyone, including everybody that is a part of that team. So that's what I would do. Like, start doing that now. The second thing that I would do now, if you are not doing it already, is be really transparent with your employees about where you are. Don't, you know, so that like our team knows exactly where we are. And like how much runway you have and how you're getting that revenue. And that has a really great way of like focusing people on the things that are going to keep you going. And I hope that poor Jenna and Divya are like, what? No, but like, we talk about this stuff in MBR like constantly. Everybody knows where we are and we know where we're going. And so do that, because if you ever get in a position where you have to make hard decisions, it's going to help a lot that they saw it coming, because they were a part of trying to get there. I don't think that I have. And do you, like, Divya, do you have any more to say about, like, I'm curious what you think about how do you communicate this? Like, if you have to do layoffs, like, what is a way to do it kindly?
You know, honestly, and I've been in many early stage companies, and we've had to, and in corporate settings where both, in either way, this is a hard thing to do, and we've had to do it. I've been on both sides of it. It's never easy. And I will say that I totally agree that a lot of it has to do with culture. Like, if you're trying to do, when we say it, we try and do it humanely, honestly, that foundation is being set before a layoff. And that's what I think you're referring to as, you know, not calling your team your family, being very clear about the goal that you are working towards. Everyone has it. This doesn't come as a surprise. If you know, how you are tracking towards revenue, as a team, like, transparency is very, very important, and it's empowering to your team. And so everyone sort of feels like they're part of the same journey. They know exactly where they're headed. And so when a difficult decision like this needs to be made, it's not a surprise. It's more like, I get it, and I know this is hard, and obviously do it in, in a manner that we don't, I mean, you're all adults here. You don't, you shouldn't be doing this over email. Please don't do that. But I think, I mean, I'm echoing everything that you're saying. It's just, don't be an asshole, and create that culture or Slack. Yes, don't do it on Slack.
Zoom, apparently.
That's not. But yeah, I think this has been a great discussion. I want to open it up because I feel like we have 15 minutes. If I want to see, Jenna, can we undo the spotlight and actually have a room full so we can all see everyone's faces? Yay. I don't know, gallery worked. But if you want to ask a question and raise your hand, please do that, and you can ask the question yourself. Otherwise, I can start off with some questions that I have in my DM.
And use the raise hand feature so that
so we can see you.
We see you and it lines you up in order until you raise it.
And well, I did notice that Rachel had a question in the chat. Do you want to say yours off or out loud?
Oh, she says.
Sure. I'm just eating my lunch, so that's why I've not been on camera, but yeah, I can read it. That'll be faster because it's a little long in the chat. So I just said, for context, my company, Simple Switch, we're an ethical and sustainable online marketplace. We're raising our first round now. We're a 4-year-old startup, so it's a safe agreement community round with WeFunder, similar to Seed Invest or Republic. That gives our customers in our community the first chance to invest with us and increase their engagement and their brand loyalty before we move on to future rounds. So the question that I have is kind of, as with that in mind, and the traction stage that we're in, I'm wanting to begin creating relationships with really great values aligned VCs that we would want involved in those later rounds as we move forward. So I just wanted to get your insight on how you'd want to be approached if that was you, or what person in those firms would be a great first touch if I want to reach out, start that relationship.
Great question. And yes, it's totally the right thing to do. Build relationships before you need them. I think for me personally, so on the fund, we look at every pitch that comes in through the website, and it's also the only guaranteed place that you'll get a reply. If you've ever emailed me, I'm sorry. I'm just really bad. Don't DM me on Twitter, dear God. It's like a hot fire in there. So like if you're fundraising, like certainly we will take meetings even if you're not fundraising. And that's sort of how we begin the relationship, is by having that first meeting. The other part is like with us, we love seeing companies through our Catalyst program and our Founder Days. And so all of the activities that we do, either myself, Rory, or somebody on the team is a part of that, and you can kind of start meeting us that way. With other investors, I mean, I would say there's a lot of opportunities to participate in programs that introduce you to investors on a mentoring capacity. So I would do those. Even as I say that, I would caution you from like becoming a serial program participant, right? Like that's not traction. That's sort of a waste of time at some point if you're just sort of going from accelerator to accelerator to accelerator. But, you know, participate in those programs for the relationship is sometimes like totally worthwhile. And then the other part is like, now that in real life events are starting to happen, go to your local ones. If you feel comfortable and safe doing so, because it's a great opportunity to meet with investors and nurture those relationships for a year. Any favorites for mentorship programming? I'm not going to answer that. I'm going to let everybody else answer that. If you want to recommend a mentorship program that you've been a part of that you liked, please put it in the comments so that we can kind of cross-share recommendations here. I would also say, one thing that has not come up in the discussion so far, but I find it extremely important, is if you do have investors, do not wait until you're in trouble to let us know. Please send investor updates, the good, the bad, the ugly. Stick to a schedule every month, every 2 months. Sometimes people do it every 3 months. I don't like that, but I prefer it over never. They don't need to be long. In fact, short and sweet is best, but like have that transparency with us so that we can help you when we actually can. Because I think sometimes you get to the point where you're so close to a real kind of make or break moment that it's too late for us to help. There's nothing we can do at that point. And then it's going to feel awful, but we're not going to be able to do anything. So please keep your investors in the loop. You know, have coffee with people once a year, once every 6 months, send investor updates. Don't forget to like help us see inside of what is happening. Okay, next question we have up here. Priyansh. If I said that right.
Great session so far. Thank you so much for some amazing insights. Just a little bit about me. I'm founder CEO of Looper AI. Looper is a no-code SaaS offering where we help companies adopt AI solutions in days. So we are majorly working a lot on manufacturing, aerospace kind of industries, you know, the traditional industries. So my question is, I started my fundraising April, which was still like, you know, a good time. And so, I mean, it's an AI startup. I already have some great traction with Microsoft partnership in place and some really cool stuff going on over there. So of course, I mean, the valuation was, I wouldn't say too high, but it wasn't too low. So it was almost, so, and I have some investors on board already. So I've got some money in and I'm in the middle of closing my seed round. So now it's tricky, right? Because when I started, the market was super good and then it just crashed in the last 2 months. So one of the things that I have in mind is like, I'm already generating revenue. So it's a post, but either I take a slow, and I've been pitching a lot to angel funds, and take a slow and like really focus a lot on revenue because I'm having a lot of traction on the customer side right now. So either focus on that and come again after like 3-4 months, or really continue what I'm doing, because everybody wants to talk right now. I mean, it's not that you're right. Like the only challenge I'm really getting is on the valuation part. Like that's the only thing. Apart from that, everybody's like, no, it's a great idea. And I mean, it's great where we want to get in. So what would be your advice? Like, do you think I should like slow down a little bit, get to a, like, a 400, 500K ARR and then go out and talk again? Or do you think I should keep talking and just want to make sure that I'm not burning the bridges, right? Like you want to make sure that's my
Can I
question.
ask you some questions? Are you comfortable sharing a little bit more?
Yeah, sure.
How much do you have in the bank?
I have enough that can keep me going for 8 months.
Okay. And if you don't mind my asking, or you can DM me if you want the value.
Yeah.
So it's hard to answer because I
Yeah.
don't know how far off you are from like a real round next time around.
Okay.
So you don't have to tell me because there's a lot of folks in this room and it's being recorded.
Yeah.
Okay, so I'll tell you, I invested in 2 companies that had that problem. Like my last 2 investments before the whiplash moment, same problem. They were not super high valuations at all. We invest like strictly under 10 million.
Okay.
But they definitely lost the momentum of the fundraise itself. And for both of those cases, what they decided to do was keep what they had, which was like a substantial amount to just ride out this shock moment and try to go out and raise the next round a few months down the line with additional traction. I think that that's the right answer for you. Because you have 8 months, and in 8 months, you can actually accomplish quite a lot. I also think that the past 3 months were a shock moment. And the behavior of investors the past 3 months is not indicative of what it's going to be in the next 12 months. The reason for that is basically like the investor attitudes changed, but the founders did not. And that is what happened in the past 3 months. So you had investors looking for lots of traction, reasonable valuations, and founders fundraising with the expectation of the past market. And those 2 just kind of like that ground pool. But that's going to change, right? Because like, I think every investor was sort of waiting to see what was happening with valuations, waiting to see what was happening with term sheets. And that is essentially going to change as founders sort of change. So I would say I'm starting to see term sheets again. We gave a term sheet last week. I'm starting to see more movement. Valuations are certainly lower than what they used to be. So I think if you have enough money in the bank, the right answer is stop fundraising. We didn't talk about the angel investor thing, and I want to say a word about that. Stop fundraising and execute. And come back to fundraising later. The only caveat to that is like, if your valuation, I don't know what it was, but if people are telling you that it was too high, I would listen.
I mean, they're not saying it's too high, but it's just, or everybody's saying the market is like, and I just feel like, I don't know if I'm just targeting the right, if it makes, because so far I've majorly spoken to angel groups. So I don't know if I mean, I have 1 VC on board.
So let's talk about angel groups.
So I don't know.
As a general thing, like if multiple people are telling you this is really high, I would listen. Okay. I would listen. And you can DM me with a valuation, and actually don't do that because I don't know your attraction. So don't do that. I don't want to speak out of turn. But if you are presenting this to multiple people and they're telling you, oof, this is high, I would listen. Especially if you trust them. If it's only 1 or 2, then maybe not. But if you have signal in that feedback, you have to listen to it, because that part is not going to get better in 6 months. What's going to get better in 6 months is check writing. There's going to be more check activity, but the valuations are not going to go back to what they were until, I don't know when, if ever, they're going to get back to what they were. And then the other thing that I would say about angel investors is like, I do not have data for this, but anecdotally, they're much shyer than they used to be. Because this is like real people whose money is in the stock market, which just like tanked, right? Like their real estate is completely illiquid. They're not going to be deploying a lot of money into venture capital. So angel world right now, pretty spooked with USDs.
Great.
I have one more question here from Katie.
Katie, go for it.
Where'd you go?
Oh. Katie.
Oh,
So sorry. Yeah. So basically, I work in anti-fraud technology, which is one of the reasons I asked about recession-resistant things. Is when people get desperate, they get stupid, and we make our money based on how much fraud people commit. What my company does is very gritty into the nature of a very esoteric part of law called QTAM and the American health insurance system. And I find that the people who believe in me have no idea what I'm talking about. And I'm like happy to sit down and give someone like the briefest explanation possible of the intersection of the American health insurance market and the legal system, and how these things work together and how there's a real need there. But what's coming out is I have a few meetings with some people who've been really generous with their time and patience for years. And at the end of it, they come out and say, I don't understand what you're talking about, but I believe in you. Here's a very low valuation. And that is difficult. And then I go to strangers who are like, wow, you seem to know what you're talking about, but how did you get in my office?
Okay. So first of all, legal system healthcare, it sounds riveting.
Sorry, I honestly like this.
Love the boring.
Okay, great. I didn't know you were sarcastic.
No, I'm not even joking. Like, yeah, totally. Like, that's where the money is made. No, I'm not being glib. So what you're talking about is the difference between friends and family and outside investors. And friends and family should be provided a lower valuation.
Okay.
Like that is normal and expected. That it does not signal to later investors what terms you gave to friends and family. Friends and family are folks that like are investing in you because they believe in you, outside of anything else, basically. When friends and family accept terms from a greedy founder, and like this, I cannot tell you how much this happens. Founder tells their friends and family, I want to raise it at 15 million valuation. They're like, okay. And then they go to VCs and professional angel investors, and we're like, no. So it is the right thing is you should be taking a little bit of money from friends and family, from like those folks that purely just believe in you, and using that to buy yourself enough runway to go out after professional investors. When you are able to tell your story to the folks who don't know how you got in their door and close their checks, those are like mark-to-market valuations. Like those are real, like, okay, that kind of stage appropriate valuations. And it sounds like they would be higher than what these sort of just friendly checks are going to be. So just separate that.
Sorry.
Separate one.
The other end of that question is we have the option to bootstrap, but the more we bootstrap, the more we get mired into the less transparent we're allowed to be, because the traction involves interaction with the legal system in a way that doesn't permit transparency, because we just lose cases if we talk about them when they're under seal. So it's kind of like a self-reinforcing. I guess that's probably not a broadly.
No, that's not an easy thing for me to answer. That's not an easy thing for me.
Yeah, it's not interesting to anyone else either.
Yeah.
Okay. Well, I really appreciate the first thought on friends and family.
There are parts of your company that are very private, and you need to go into diligence with an investor. At the point of diligence, if you have that legal requirement, then I think investors might be not at the point of send me your deck and have a conversation with me. You need to be able to talk high level about your business and your results. So if you can't talk about that, then you're dead in the water.
No one is shy during diligence.
Examples, then maybe you can put the investors under NDA or just kind of like redact.
Yeah.
So, but that's a little too specific. I'm gonna.
Yeah. I'm sorry. Yeah.
No, totally okay. Divya, let me hand it over back to you. We are at time.
We are over time. So I want to be respectful. Thank you, Leslie. Thank you for this amazing conversation. Thank you, everybody who could join us today. Hopefully, you all receive our newsletters. Please add us to your contacts so that it doesn't go to spam. Sometimes that happens. and stay tuned for upcoming programming. We are gonna be opening up our apps for the next Catalyst happening in the fall. That's going to be happening next week. So look out for call for applications in our next newsletter. And have a great day, everybody. Thank you for joining us.
Bye, everyone.
Bye.
Thank you.